Good evening, afternoon, and morning to our global fans. You're in store for another fantastic episode from the Deep Q Cast. With you, you have your fearless host, Robert Ridzak, along with the fantastic, the well-endowed and intelligent co-founders, Carlos Zendejas and Matt Reed. We are here for a very special holiday episode of Deep Q Cast. As you can see, my patrons here have their holiday beverages. I have mine. It's obviously getting very chilly outside, so I like to try to keep it warm inside with a little tequila. Try to keep the sunshine in a glass. My it looks like
nice.
It looks like you could say that there's perhaps one Grinch on this episode who decided not to show up in festive holiday gear. Which one of those? I'll leave it to you
I like
to
to sit
decide.
in my cave and ponder how much I hate Christmas.
For all of you folks listening to us audio-wise, Matt Reed has decided to not join us in festive holiday wear this year, but he is drinking a festive Guinness pint. It looks like some stout. Is it Guinness, Matt?
It is actually.
But Matt's English, so Guinness is just pretty much just like a regular Tuesday for him.
It's like coffee. That's how he gets going.
It's like 9 a.m. on a Tuesday is Matt drinking Guinness. You know,
Carlos,
we actually used to have a. I'm drinking a very nice festive spiked eggnog with a little bit of a Diplomatico rum.
I almost forgot about eggnog. I feel like, it's like it disappeared. I was reading an article that something like 90%, 95% of eggnog is consumed in November and December. I mean, an eggnog producer. This is
It's because it's like fucking disgusting unless you add rum to it and you're wearing a Christmas sweater.
I've never seen it sold any other time.
I really want to try to drink eggnog in July.
It's like, no, but seriously, like if you're drinking warm spiced milk in the middle of July, that's absolutely
That's on
disgusting.
you.
Yeah.
You hate yourself. That's what it comes down
It's
to.
going to be like heated eggnog in July for like a July 4th barbecue.
Yeah.
You'll see it at my house. Come over. Come over.
Yeah,
this is why I have no friends.
Come
This is
over.
why I have no friends.
Yeah, swing up to Connecticut. I'll cook the burgers and you bring the spiced heated eggnog, please.
Oh my goodness. Oh my
It'll
goodness.
be a good time.
Absolutely, absolutely. Well, I know all of you will be waiting with bated breath until you get my invite for July 4th Eggnog Fest in my backyard. But until then, perhaps we can go through a weekly roundup of activities. Obviously, coming along with the holidays, trading activity has come a little light. We'll talk a little bit more about range-bound trading prices and what that means within the HFT markets. We'll talk a little bit more about Binance. Obviously, that's been a very, very large topic du jour over the past several weeks, given CZ's comments around FTX, and there's been a lot of back and forth commentary around their financial stability. And then we'll wrap it off with, again, leading into FTX, SBF, some updates on that, and then close it out with a little bit of a macro theme, talking a little bit more about rates and some of the news that we've seen through the Bank of Japan. But perhaps kick things off a little bit more about around Binance. We saw the news. I mean, they've been getting a lot of outflows, but they seem to be handling it pretty well. Like they've processed something like $15 billion in outflows without any problems. What do you guys think? To me, it sounds like they're able to manage this stuff pretty well.
I mean, it sounds like that's what any good exchange should be able to handle. I know we talked about this last week, that they shouldn't be in the business of even being worried about how much they have in assets at any moment. It's like I think we mentioned they actually can charge money off of people withdrawing, so it's like a good thing for them. And if they're doing it one-to-one, then it doesn't really matter. Funds are segregated, completely different thing to what happened at FTX, and that's the key. Like they mismanage funds. So the fact that they've handled that and seem pretty confident about it going forward. Like, again, we don't know the full extent of what liabilities they have, but they tell us that their funds are segregated. So I think it's at least a good show that they've managed to handle that volume for sure.
Yeah, I think to me this is probably the biggest indication that as a trader, maybe the last thing that you want to do is to get addicted to doom scrolling on Twitter, because well, so and there's a bit of like a tale of two cities here, because I remember when SBF and FTX sort of went down, Matt and I, were actively monitoring risk, and I would hands down say that Twitter was probably the only place where we could get reliable news about the subject, right? Like otherwise you're just sitting around being like, oh, they're probably okay. This SBF guy just wants to save the world with his, philanthropy. And I think maybe it went the other direction with Binance, where it's just like everyone wanted to make a name for themselves and be the person that called it. And so I think that it went really overdone. And as a trader, you really need to sort of like make sure you put yourself on an information diet and screen for bits of information that I think give you like an accurate view, but you're not, doom scrolling and listening to every little piece, because every little piece of news should not be weighted the same in your decision-making criteria.
That's true. I mean, I think in this circumstance, it certainly pays to be pessimistic, because you actually gain no real advantage in keeping all your assets on exchange. Like, unless you really need that to like fund your operations, like put it somewhere else, like put it in a cold one.
Well, that's a way different story, I think. Like, people are managing their counterparty risk, and we talked about this last time. That's exactly what you should do. It pays to be very, very, very pessimistic when it comes to counterparty risk. Limit that, cut that shit. Even market risk to a degree. Like, if you don't feel comfortable, if you don't have conviction, I think one of the most important things you can do as a trader is to be on the sidelines. But then again, I think there were a lot of people that were like actively wishing for the downfall of Binance, which I think would be just a terrible. No, I think it would like be a terrible thing for the industry to sort of. But they were wishing for the downfall of Binance in order to suit
Elizabeth
their
Warren
narrative.
licking her lips, please.
Yeah, no, like, you've got like Elizabeth Warren. She's like all these, lawmakers that are looking for yet another reason to jump in and protect us from, these charlatans and cretin in crypto. I think you end up with I think the Bitcoin maximalists that wanted basically like anything but Bitcoin stored in cold storage to go down. I think that was a big narrative as well, and I think there's just a number of people that were trying to make a name for themselves by jumping on the thing. And I think there were some valid concerns, but I really do believe that this particular one was very oversold.
Yeah, I mean, the nice thing, time will tell. That's the beautiful part of it. But they did manage to buy Voyager's assets, I think, this week, right? Well, they at least entered into an agreement to. That was close to like $1 billion. So that's kind of like, they clearly have money to spend. Hopefully not customers.
I guess, I guess to play devil's advocate, it is somewhat telling that the CZ seems to be following the SBF playbook to a T, right? Like, they're setting up a trust to go save crypto, and they're buying out people that they owe money to, and all that sort of stuff. And they've got a token that they own. Like, I think people are right to be skeptical, but at the same time, if there is fraud, I don't think it's the same fraud as FTX. They handled over $15 billion of asset withdrawals. They managed to live to fight another day. I think that we're probably going to be stuck with Binance, whether you like them or not, for at least, the near future.
That touched on something. So we were talking about people moving coins off exchange. And that's also a sign of crypto winter, right? So people don't have, the liquidity is drying up. People are moving it off. It feels like, I'm curious your thoughts, that the main catalyst is more counterparty risk than overall market opportunity set. Like versus as like relative to other cycles that have happened, like in 20 like was it 5 to 10 years ago. Seems like this is a little more counterparty driven.
Yeah, I mean, I can definitely talk to the volumes that we've seen this last week. Like they are definitely lower. So we kind of look at this measure of taking in US exchanges, so Coinbase, Kraken, Gemini, a couple of other big ones, and look at the 10-second trading volume. So during last week, that was around 2 Bitcoin in 10 seconds on average. And we had quite a lot of news last week, remember? So CPI and the Fed rate decision. This week, it's down to like 1, a bit under 1. So it's definitely coming off as we tail into the Christmas period. And to be honest, Christmas liquidity sucks in no matter what the asset class.
But that's to be expected in any asset class. I mean, I remember being around in FX, and that's actually the worst time to be on the desk as a trader because liquidity shit. And then you have a bunch of guys that I think hate their lives and families that just sit around waiting to pick people off in low liquidity environments. and then
everyone has a story about that.
It's absolute garbage that you just have to sit there. So I remember everyone assumes that if you're sitting on the desk during a holiday period, it's going to be pretty chill. And I think probably some of the most stressful market closes that I've seen personally were, sitting on the desk on a Friday afternoon just before market close in FX and just saying to myself, and I know exactly who these guys were on the other side of the screen, being like, God, don't you just have a life? Don't you want to go home to your family? Instead, they're sitting here like nicking 20 lots off of banks left and right. It just drove me crazy.
How does that work? So just regarding market liquidity, maybe for listeners out there that aren't as familiar with markets, obviously, people are going home, so liquidity is drying up. But how does that overall affect financial markets?
So I think it's kind of like who is that in terms of like who. So normally you have like HFTs that are there and provide like a base level of liquidity, and then you have market participants. So HFTs like high frequency trading desk. And towards the very end of the year, a lot of them are like have either made their mint that year or not, and so it's kind of like what's the point? And then a lot of desks have lower risk appetite in general towards that last week. Some people are away, you may have juniors on, so they'll generally be asked to like run risk light into year end. And that's because a lot of people are away. There's still oversight, of course, but it's limited, and so risk appetite is lower. The lower the risk appetite, the lower the volume, and so it's kind of like a self-fulfilling prophecy that clip between Christmas and New Year is just pretty quiet.
And then you also, there's a very real thing that happens on trading desks, both at hedge funds and at banks, which is by this point in the year, comp has already been decided, right? So if you're a trader and you're sitting around trying to eke out a few extra bips performance on just before Christmas, you're not really doing yourselves any favor because people are really looking at your year-to-date performance, and this month kind of just doesn't matter. So a lot of people kind of use it as a month to take their mandatory vacations, to head off and visit family, or if you're an HFT, a lot of these guys will wind down their strategies and use that to tweak their models and really do some because you end up with these housekeeping projects that you've always wanted to do but you never really had time. So this is like the perfect time of the year to do that. And then
really,
ultimately, what ends up happening is what you'll find is that if there are people on the desk actually managing risk, it's juniors. So it's guys that really are not like the number one risk manager, and so you're also prone to not only lower liquidity, but you're also prone to more operational errors that can be seen as like someone's mistake might actually end up being a big blip in the market. And it's actually really funny because you'll see someone on CNBC or something talking about what happened, and they're like, oh, the reason why the market crashed today is because of reason X, Y, and Z. It's like, no, the reason why the market crashed is probably because there's a first-year analyst at Goldman that fat-fingered an order. And that turned into a huge dip before they figured it out and bought the other way around. So, there's all sorts of narratives fitting to random data, and a lot of it you would be surprised is really just understaffed desk trying to figure out what to do in this type of market environment.
Interesting. One of the things I was always kind of curious about too, maybe just backstepping it a little bit. We're talking about Binance and some of the dealing with the fallout of SBF and FTX. Some of that news also came. Obviously, SBF was arrested in the Bahamas. I did find it very interesting that I believe he was arrested the day before he was supposed to testify on Capitol Hill for Congress, which I thought was kind of bizarre, the timing of that, and why they didn't wait until after he testified. I thought that could be really helpful for them. But outside of that, we had two folks that were very closely connected to SBF. We had Caroline Ellison and Gary Wang, also flipped on SBF. They're trying to get out of sentencing time, And it's not looking really good for SBF. I know he was able to post bail on $250 million, which seems like a lot, but I remember I was actually looking through other people that have been fraudsters on Wall Street that caused a lot of damage and what their bails were set at. And I think I was looking back, like Michael Milken from '89, with all of his junk bond racketeering. He had a bail right around that amount. So I don't know, like inflation adjusted, I guess it is kind of like a slap on the wrist. What do you guys think?
I mean, like Barry Madoff wasn't allowed to get bail, so that's another data point. So I mean, I don't really know, and I think like people, I saw a lot of outrage on Twitter. It's like, oh, where did he get 250 million? I'm like, guys, like do a little bit of research, figure out how bail in America works. It's like a personal recognizance bond. You don't have to put up the full 250. Now, you still do need to put up a little bit of money, and I think his parents put up their real estate, which was likely bought with FTX funds anyway. So is there a little bit of shadiness going on? Absolutely, right? Like no one believes that he's sitting around for someone who claimed to have 100K in his bank account, which is still a lot for the average American. Like there's no way that he's putting up that kind of money, even if it's only a fraction of 250 million. But I without putting on my massive like conspiracy theory tinfoil hat, I'm sort of like let the justice department kind of like see this one through. I don't trust that it's been a clean process by any stretch of the imagination, but I think this is just what ends up happening when you've got really powerful, influential people going through the justice system in America. It's like sort of almost what you'd expect at this point. So maybe that sounds jaded, but I think the bigger thing, at least in my mind, is I think it's hilarious that his number one and number two flipped on him. So while he was on, Twitter Spaces and trying to cover himself on CNBC, Caroline and Gary were just singing to the feds. To me, that's kind of funny. I think he's going to get absolutely fucked. The big question in my mind, like aside from the tabloid nature of it all, if you think about it, all right, well, how does this actually affect the market? The big thing in my mind is, well, what information is going to come out in the trial that could negatively affect it? And most importantly, like, do you think, and this is probably a good question, do you think the feds view Sam Bankman-Fried as sort of like the final boss? Or are they going to try and get him to flip to get more information on, for example, like Binance or Tether or something like that?
I don't know how much information he would have to offer up for that. I mean, we just don't know.
I could see them, but for example, I think he's pretty well. Like he's going to be the number one user of Tether, or the number one originator of Tether.
Yeah, you have to post cash into it in order to get the Tether released anyway. So, like, and if he was using customer funds for that, I mean, that's pretty shit in the first place.
Yeah. I know it will be interesting. How about this? It wouldn't shock me to find out that SBF was acting in concert with other types of people in the industry, which is somewhat concerning for me. I don't think that is the case. To be honest, I think he's the final boss. I think they're going to come down really hard on him personally. But I think like you just need to hold some space for the likelihood that there is some additional bombshell evidence that will come out that he'll, I think he's demonstrated that he has no problems trying to take down other people to save himself. And, we'll see what information comes out. Should be interesting.
Yeah. I mean, I'm kind of curious also just from like political affiliations too. I don't think we'll ever really find out on that angle. To your point, like if there is something, it probably would come out within the crypto industry more than anything within the connections to politicians.
Yeah, like the politicians are not going to fuck themselves in this thing, right? Like they're going to be like, oh,
going to stay.
By the way, when we were investigating this guy, we actually realized that we were carrying out fraud and we were misinforming the American people.
Yeah,
that will certainly not be the case. I can guarantee that.
I was just going to say, I mean, that's kind of one of the reasons why I mentioned just the fact that he was arrested and wasn't able to testify before that. I just wonder, like, his ability to have a podium to talk about these things that get grilled. I thought the timing was uncanny.
Yeah, I think one piece of information that did come out, and this is, I'm not sure it got a lot of coverage though, is that he is getting busted for securities fraud on FTT, which means that the SEC has classified FTT as being a security. And I think that that's actually somewhat of an interesting thing, because that has implications on not just SBF, but that really has implications on, you know, pretty much anybody, any venue that sold FTT, any venture capitalist that invested and took FTT tokens. You know, I think that, to me, that's actually probably the most important narrative that comes out of this, aside from the tabloid fodder that comes in a slow news cycle when it's like coming up on the holiday and everyone likes to, you know, feel good about themselves for seeing SBF, like, you know, looking disheveled and getting carted out of a courtroom. I think there's going to be a lot of fallout from this, you know, from a market's perspective. I don't know, Matt, what are your thoughts on that?
Yeah, I think so. We touched on like the securities and how we test last week. I was actually reading a really good blog post from Brian Armstrong, CEO at Coinbase, and he was basically saying, you know, everyone's been asking for regulatory clarity, but like, what is that? Like, what does that actually mean? And really, it's just around centralized actors in crypto, people that are issuing stable coins for one, exchanges themselves, and like custodians need to. Those kind of three core business functions need to be regulated and operate under the same rules that the TradFi guys do. And I think he was pretty open that that seems fair and the right way to go. So that's kind of one piece. And then, like for securities themselves and the taxonomy of these, you know, these assets that we have in crypto, like, yeah, it needs to become. Someone needs to go through maybe Congress and say, look. These are the defined rules. This is how, like, the modern day how we test looks. And if you're not on this, you're a commodity. If you are, you're a security, and therefore, you know, need to think twice before you start issuing. Basically, I mean, like, I think what was a few things that come. So parts of that test were like, if there's an investment of money. So, are you trying to issue something and get cash off the general public for the purpose of building a project or a business, which kind of FTT, you could argue, is using that for? Then, you know, that is a security. Now, you can, or like an ICO, for instance, an initial coin offering, that would be deemed as a security under this framework. So, yeah, I think it's going to make people think twice about that. Oh, by the way, just because it's an ICO doesn't mean that's like illegal. You can raise funds, like for instance through a safe mechanism or a bond you can issue to investors for equity in your company, as long as they're accredited investors. So there are ways to like issue securities that are get exemptions under today's framework, and that's really just so like startups and stuff can raise funds without having to go through a lot of rigmarole. So it's not like the end of the world if that is the case, but yeah,
like
there's a lot more around this definition.
But ICOs would be, I mean, it's going to be really hard. I mean, you mentioned like only the accredited investors, right? Did I hear that correctly?
Well, there's some on-chain stuff now that's letting people invest in portfolios of like real estate, for instance. Now, their KYC process is, okay, are you an accredited investor? So like that does immediately take out a good chunk of population, but I'm just saying as a step one, that KYC really needs to be done. Because right now, if you're a startup trying to do it, that's what you have to do. So I'm just saying that like there are rules in place that allow you to raise funds today, but you know, you just have to do it in the right way. That doesn't nickel and dime mums and pops that don't have the money, that may not have the money to lose.
Yeah, I think the big key, and you kind of nailed it in my view, is when you talked about a modern day Howey test, which is like, I think, you know, a lot of these securities laws were written and adjudicated when the concept of, you know, a digital asset just didn't exist. And so like the flexibility of digital assets, I don't think they need to be less regulated. I just think it's somewhat of a futile exercise to try and regulate them with, you know, tests that were written in the early 1900s about like physical stocks, certificates, you know, stored in a custodian bank. But I think that the downside with that is that we're probably because it's so difficult, I don't think that there are a lot of legislators that are equipped to handle that. Meaning if you listen to some of the, bloviating from some of the guys on the Capitol Hill during the, FTX trial, which is like the degree of competency about, how crypto works is, pretty apparently that they just have no idea how it works. So
well,
in my mind, I think what will likely end up happening is that we're going to get more regulation by enforcement, and then that's going to lead to, these things getting settled in courts, and that's going to be a really slow process because these these court things are going to take years and years and years before we actually get regulatory clarity. So I think if you're looking for regulatory clarity as your signal for when the market's going to pop off again and we're going to get trillions of dollars of of stuff in, I honestly don't think that's going to be, at least for a couple of years, because that's just the pace at which these things go.
Yeah, I think that's why it has to come from like Capitol Hill somehow. So I don't know who's going to push it, but that's the only way you're going to get that clarity sooner. Because as you said, the court process is years, and it's on a case-by-case basis, which is just too long.
Yeah.
But it's interesting. Like there are some concepts of what to do about a decentralized project. If it's not like a centralized organization at that point, like a company. So it's not like a common enterprise. So what are you investing in? If it's something that's run by code, you're not making money off of with the expectation of like profit necessarily, or off the work of others, which are like the other key part.
Well, that's the other thing too, is the key part is one of like the work of others. And so, for example, a lot of people will talk about, oh well, then Ethereum is Ethereum's a security, but like I think that's kind of a dubious test, right? Like if you run your own node as a validator in Ethereum, does that mean that it's a security? Because you're technically not working off of the efforts of others. You are running a node, which is non-trivial. So there's, it's nuance, which is basically to say there's not a clear
MasterCard is a security in that sense, right? Because it's running nodes that are validating and moving transactions, which is effectively, as long as you're not directly involved in the profit of that transaction, then it's kind of like you're just assisting the infrastructure to move money, really.
Yeah.
Interesting.
But I think, without going too far down the regulatory rabbit hole, I think it's interesting to see how this will play out. No, we could probably talk about this for a very long time because
I think the best way for that would be we jump on with one of our legal guys at some point and try and do a little overview.
Yeah, I think that's a great idea.
Collate some questions and get a bit more back.
Yeah, maybe we could save it for another episode, but would be curious at some point. We could talk a little bit more about regulation because it does feel like it's the 800-pound gorilla in the room, and there's so many there's so many competing interests, right? You have different regulatory agencies that are competing over control, and they want to have budget and power and influence for their own personal reasons, and some of them have very valid arguments for why it should fall under their jurisdiction. You also have a lot of other competing interests, right, from the private markets. Like who stands to benefit from a regulatory ambiguity as this thing falls out. There's probably existing enterprises in the space that might benefit from that because other enterprises are more reluctant to actually enter the market given this uncertainty. So if you're already in it, maybe it's just easier to stay in it. So maybe we could talk about that at some other point. I know we're kind of running up a little bit on time. We have a little bit more of a macro topic here with Bank of Japan. They kind of surprised markets by relaxing some of their bond policy, allowing the yield on their 10-year to rise as high as 50 basis points, which, as I understand, is double what it was previously. Yeah, very, very. So maybe pass it over to our bond guru over there, Matt Reed, to talk a little bit about that.
Yeah, I mean, they're certainly following the hawkish global peers, right? And it kind of marks the end of this negative rates period that we've been in for the last 10 years, or globally at least. So like various economies, Japan in particular, have had negative rates for, since the 80s, 90s? I can't remember. It's one of the longest.
At least 30 years that they've had.
Yeah, and then you've had...
Zero or negative rates.
the ECB as well for the last 10 years or so, combined with quantitative easing. I guess like we could talk about what they are. I guess like the general tools for central banks to control target inflation and price stability will be quantitative easing. So that's them buying bonds. And might think, well, why would they do that? So the price of bonds is inversely proportional to the yield. So if they want to keep yields in a certain target range, then they can basically just buy or sell the assets themselves. And so they've been doing this in the ECB for the last 10 years quite aggressively. One of the interesting things now, so as we've entered this period of inflation, rising inflation, like globally, governments have been trying to reduce the monetary supply. So they do that by increasing the interest rate, which has a trickle-on effect. So, for instance, the Fed have a federal funds target rate. They actually mandate banks to hold a certain amount of reserves at the Fed. And so when interest rates are low, that means the banks are like, oh, well, I'm only going to get a small amount of interest by holding this like capital buffer that they have to hold there. So then they go and try and lend it out to make more revenue. When the interest rates start to increase, we're at 4.5% now, it certainly entices them to think twice that I can make pretty riskless bet here by putting it or even more with the Fed. It's just a minimum requirement. So you can get pretty good yield just by doing that. And therefore they stop lending so much money, hence like reducing the monetary supply. And in doing so, less expenditure would then bring down inflation in theory. So like they have these tools that they can use, and the Bank of Japan has like just decided, holy shit, like everyone else in the world is raising, I have to like do something. And what we've seen, Carl's probably talked to the FX rate better than me, but the rate at which the yen conversion to dollar just went through the roof. And it's kind of just been on this slow grind up. I think it was like as high as like 160 or so yen to the dollar, which is pretty high. I think it's like 133 now, which is like 15% rise on the year alone. So they had to do something, especially if you're in a economy where you have a negative trade balance. So what I mean by that is if you're importing more onshore versus you're exporting. So you actually need to raise funds to buy those things. If your your base currency is weaker, it actually costs you more. Therefore, it can be detrimental to inflation again. It's costing you more to import those goods. So there's kind of been like a lot of knock-on effects, and Japan has like finally been like, okay, we've got to get with the program. Everyone's doing this.
Yeah, I saw a good sort of meme or a thing. It was like, explain the Japanese rate like I'm 5. And the best one that I saw was Japan, as an employer to its people, does not pay them a living wage. And so all of the people of Japan work from 9 to 5, and then when they get done, they're forced to go out and work a second job. And the world has gotten used to cheap labor on nights and weekends from the Japanese people because every single one of them does not make enough in their 9 to 5 to cover their retirement, so they have to go out and work for cheap on nights and weekends. So what happens to the world economy when Japan finally says, actually, you know what? We've been underpaying for years. We should probably actually, give you guys a working salary. The fear is that Japanese people are going to be content with their 9 to 5 and no longer go out and basically give free labor on nights and weekends. And if the market outside of Japan has come to expect that, well, that could be a big problem. It can cause a huge surplus. So, like, if you replace their time with their capital, imagine like the average Japanese salaryman is getting money and not getting any interest, right? And their stock market's been basically flat for the last 30 years. So in Japan, and I know this to be true because I've traded, with, Japanese retail for ages, there's a very common thing, which is you take your yen, you sell that, you exchange it for, Turkish lira or, Argentinian peso, or, you name the EM country that's paying out a 10, 12% bond, right? And you just earn carry. And carry is basically like, I'm going to swap out my 0 or negative interest rates in yen I'm going to convert that into Turkish lira and get paid 20% per annum there, and I just do that. So they've been taking their money and parking it overseas in American stocks, foreign, sovereign bonds for ages. And I think as a result, right, the Japanese people have become a significant force in the macro community because they've been forced to go out and chase yield for decades. And so this actually kind of marks a bit of an end of an era where the BOJ finally said, actually, no, we're going to pay ourselves a working, pay our people like a working salary. And I think like the 25 to 50 basis points, like we're talking about 0.25% raise. But I think the expectation that that dam is beginning to break and it's going to yield to more raises and they're going to follow more and more and more, I think is actually a pretty interesting phenomena that's happening in the world macro environment.
The really interesting thing for me about that is like they already have the highest budget deficit. I think it's like 230% or something, like debt to GDP. Like if they then start increasing interest, then that's only going to compound it. And it's like an interesting phenomenon that's been happening globally now with this interesting increasing interest rates. You have people that have, for instance, in ECB that bought bonds now. The yields are going up, so the price of those bonds are actually becoming worth less. Not worthless, but worth less value, right? The PV of those bonds are going down. They're actually having to now report losses, and that's kind of compounding across the European Union. And I think even the Fed, right, with this in July, I think they were going to have like going to say they'll report a 60 billion loss next year, and we're going to start paying the Treasury, which they can do as a central bank. They can do this. It's like they can operate on a negative income basis. But that was before all these hikes to 4.5%. So it's kind of like, I think that could double. And if you talk about, 100 billion in the grand scheme of potentially 35 trillion, if they do this new 1.7 trillion policy, it's just kind of eye-watering, like the levels of debt from these centralized institutions.
So this somewhat reminds me of that joke where you've got two guys in the woods and they run across a bear, and one of them puts on his running shoes, and the other guy says, "Why are you putting on running shoes? You're not going to outrun the bear." He's like, "I don't need to outrun the bear. I just need to outrun you." So I feel like the Fed right now is the guy putting on the running shoes, because I think the Fed is in a much better position to handle prolonged interest rates than, for example, like the ECB or the BOJ. Right? Like,
for sure.
The ECB knows that if they raise rates, then maybe Germany can handle that, but they are absolutely fucking Italy and Greece, right? Like, those guys are going to be in default almost immediately. They're going to have unrest there for a very long time. In Japan, as you said, Matt, like they're already got a massive GDP ratio. So if they raise their interest rates, then like how do they sustain themselves? Like pretty much all of their income is going to go towards servicing debt. And I think that you can see that's one of the reasons why the BOJ was so reticent to actually make this move. Mm. They were actually going out and trying to defend their currency by, actually intervening in the FX markets, and they've depleted almost all of their currency reserves, which is why their hand was sort of forced. So if you think about like what the U.S. is doing right now, it's like the benefit of being the world's reserve currency is that you have the ability to outlast everyone else when it comes to raising rates. And I think that the dilemma that you have as the world's reserve currency is that as the governor of the Fed, your responsibility is to your domestic constituents, but you also have this global responsibility where when you raise rates, you also sort of set the table for all of these other counterparties on a global scale to just get absolutely wrecked. And I think that's what you're going to start seeing right now with, especially the ECB and as well as like the BOJ.
Awesome, guys.
Yeah, I think that's in part why they were, like, I know some European governments have been pretty upset about this new bill, just due to the fact that, as well as increasing rates, like unprecedented highs in the last 10 years, they then have a huge spending plan that's going to entice any corporate investment in green technology to just come to the US as well. So kind of like a compounding effect of, well, we'll make all the yield here and then we'll get all the talent here as well. I think there's interesting things at play.
Yeah, I think, like, all in all, if you kind of like, well, how does that affect me in the near term? Well, I think you can say, you might be bullish U.S. risk assets, but you're probably, or you might be, bearish U.S. risk assets, but you're probably more bearish, other risk assets.
Mm-hmm.
I think the other thing is, generally speaking, you should not be super bullish risk assets because the world central banks have said, we're going to keep doing this, and this is going to be bad for risk assets. I think maybe the only credible case I could believe about people being bullish any risk assets is basically U.S. equities or U.S. based risk assets, just because people maybe credibly believe that the Fed has already done their damage, and now they can afford to kind of back off and ease a little bit and get back to a place where they're willing to stimulate the economy.
That would be interesting because the GDP numbers this week were pretty strong. Certainly not a signal like we're entering a recession in the short term. And then what's their plan for Fed, right? February, and I think the market. So we were looking at this earlier. The market was like down a bit from last week. So I think it's like 70% probability of a 25 basis point hike in February. So the market's kind of reflecting, like, what the Fed actually has runway to do a bit more. At least we're not seeing a cooling off. So I think the big number is really going to be the jobs market, so the non-farm payroll in early Jan. I think it's Jan 6. Like, we'll be keeping an eye on that.
Yeah,
Ooh, that'd be a good one.
I mean, say what you want about J-Pow. He is good at one thing, and one thing only, really, which is he tells the market what he's going to do, and then he does that thing. And anyone who doesn't believe that at this point is foolish. They're absolutely.
His forward guidance is pretty good. Yeah,
yeah.
That'll be interesting. We'll definitely be able to chat about all of this in the new year. Yeah, it's coming up soon. I thought perhaps before we round up this episode, since it is the holidays, I have a question for both of you.
I'm not saying
Are you saying that GDP numbers aren't festive, Rob?
Thought I would do a little festive garnish, topping a little bow.
You fucking Grinch. Everyone loves to talk about J-Pow over the Christmas holiday, dude.
Santa take us. He's more like the Grinch. He taketh away. So I'll start with you, Matt. If you could have your stocking stuffed with any cryptocurrency, blockchain, Web3, smart contract platform, if you could have your stocking stuffed with any one of those, what project would it be?
So not financial advice whatsoever.
Not financial advice.
Absolutely not financial advice.
Probably Ethereum, to be honest. Just like we were talking about utility last week, and I generally think that it has the potential to overrun Bitcoin in market cap. And I think, now that it's proof of stake, it has and they've got some really interesting layer 2 capabilities to increase the transaction rate. That with like decentralized PIN reconciliation and authentication. I think they've got some really interesting stuff happening on that platform. So I think Ethereum for me is like the one interesting one that remains to be high in utility, which is a key for me.
Interesting. Yeah, I even saw. I'm trying to keep tabs on. There's a lot of different corporations that are looking to launch NFTs, and you leverage different smart contract platforms. I'm kind of interested to see how all that grows. Carlos, again, obviously not financial advice.
I think one of the things that they were trying to do that I thought was, I was going to say one of the things was their data, like distribute databases. I think it's pretty interesting. So we used to have something at CERN, what's called the grid, where you'd have like servers set up to run with massive terabytes of data in the background. And that, from a compute perspective, is just like, you can then do anything on that. As long as like it's efficient and transaction rates are quick.
Matt, was that a flex that you used to work at CERN doing particle collision?
We just glossed over that. That's fine.
Is that the physics equivalent of being like I went to this little school back in Boston called Harvard, if you've ever heard of it.
it is then.
Love it. Love it. Okay, cool, Matt.
Yeah, but that to me is really exciting. I think they got some cool stuff.
Yeah, that's like, I don't celebrate Christmas. I invented the God particle. Go fuck yourself.
Love it. Carlos, what about you?
So this is the crypto equivalent of you asking me what my favorite sexual position is and me saying,
Missionary.
missionary with my socks on. But I agree with Matt. I'm an Ethereum maximalist, if you want to call it that, at least from a technology perspective. I've always been a believer that there will be other blockchains that have a space in the world. But I think in terms of like, for the highest value transactions that need to be run on a smart contract, I think those are going to get run on Ethereum. And I think Ethereum's got a pretty clear roadmap. They've not always been the best about executing that roadmap, but I think my counterpoint to that is like, name me another layer one technology that has executed on their roadmap, right? Like, how long have we been waiting for Cardano to do anything viable? They truly move at the speed of academics. And I think you've got some guys that move fast and break shit. I think like Solana and Avalanche are, good cases of that. But, in some ways, they've sacrificed a lot of things that make, they've sacrificed a lot of things that make, things decentralized and blockchain. And I think, there's always going to be the community of what I would call like, the Bitcoin maximalists that, hate on anything that's not Bitcoin and the Lightning Network. And I think Bitcoin's super viable, and I'm not, I'm not an evangelist for Ethereum, but I think it's probably the most viable thing. And I think it probably has the most likelihood of it getting adopted by the current financial system and being used as a very important part of the rails. I guess if I had to pick something that's not Ethereum, once again, not financial advice, I actually, believe it or not, I like Solana, and I like Solana at these levels, primarily because I don't think it's inherently a bad project. I think they do have some fundamental problems with, moving fast and breaking shit, and they're probably a bit more centralized than they should be. But if anything, I think FTX going down and them kind of flexing a little bit of autonomy, provided they're not like totally fucked from a treasury perspective and the ability to move forward their technology, I kind of like it. I think it's a viable alternative is just sort of like a really fast blockchain that's good for what I would call like lower value transactions. So that'd be my, if I had to be greedy and pick something other than Ethereum, I'd probably pick something along the lines of, Solana.
Interesting. Yeah, I always like, that's good. I like it. We got our blue chip and our value play. Thank you very much. I was really curious to hear that. Hopefully, all of you were good gents here.
Before we drop pedigrees here, I did go to Columbia Business School, so I've got a little soft spot in my heart for value investing.
Attaboy. Who knew that value investing in crypto? I feel like those are like an antithesis of value, but there are,
I think Warren Buffett's probably just like, shitting himself to find out that there's someone out there using the term value investing to correspond to crypto. But here we are.
Can you imagine sitting in like an old chair somewhere in Omaha? Oh, someone said value investing in crypto in the same sentence. Oh my gosh.
I also am from Omaha, and funny enough, especially around the holiday period, I would see Warren Buffett around town. I actually had the distinction of bussing. I didn't wait, but I bussed a table at a little restaurant, little diner out in Omaha, Nebraska that was previously eaten at by Warren Buffett and Bill Gates. It's a total dog and pony show. Like generally speaking, he likes to have this like, I'm just this hometown guy. So every once in a while he'll make an appearance at a diner, and he's got a couple places. So I grew up in the neighborhood that he lived in. or at least that he pretended to live in between times of like living him in his like Central Park Avenue South like penthouse. But yeah, he used to show up. I'd see him at the Village Inn, like, you know, getting a slice of cherry pie and a glass of Coke and leaving like a 50-cent tip to the waitresses. So that's my fun fact about Warren Buffett.
I was going to ask what kind of tipper he is. That's what I was expecting.
He's a notoriously terrible tipper, but that's how you don't get rich by giving away money. Come on.
Oh my God. Yeah. Wild. Thanks, guys. Hopefully, you all were good boys this year, and your stocking standard will make a special deposit for all of you guys on your calls.
I can sound like he's gonna use the bathroom in the stocking.
What are you talking about?
Imagination.
Thanks, guys. Yeah.
Yeah, Merry Christmas.
Merry Christmas.